$5 in my pocket at the end of each month. Hardly exciting. A year later, the depressed Oregon real estate market had begun to pick up. California investors, flush with money from their still booming real estate market, were moving north and buying up Oregon and Washington. I sold that little house for $95,000 to a young couple from California who thought it was a bargain. My capital gains of approximately $40,000 were placed into a 1031 tax-deferred exchange, and I went shopping for a place to put my money. In about a month, I found a 12-unit apartment house right next to the Intel plant in Beaverton, Oregon. The owners lived in Germany, had no idea what the place was worth, and again, just wanted to get out of it. I offered $275,000 for a $450,000 building. They agreed to $300,000. I bought it and held it for 2 years. Utilizing the same 1031 exchange process, we sold the building for $495,000 and bought a 30-unit apartment building in Phoenix, Arizona. We had moved to Phoenix by then to get out of the rain and needed to sell anyway. Like the former Oregon market, the real estate market in Phoenix was depressed. The price of the 30-unit apartment building in Phoenix was $875,000, with $225,000 down. The cash flow from the 30 units was a little over $5,000 a month. The Arizona market began moving up, and a few years later, a Colorado investor offered us $1.2 million for the property. The point of this example is how a small amount can grow into a large amount. Again, it is a matter of understanding financial statements, investment strategies, a sense of the market, and the laws. If people are not versed in these subjects, then obviously they must follow standard dogma, which is to play it safe, diversify, and only invest in secure investments. The problem with secure investments is that they are often sanitized, that is, made so safe that the gains are less. Most large brokerage houses will not touch speculative transactions in order to protect themselves and their clients, and that is a wise policy. The really hot deals are not offered to people who are novices. Often, the best deals that make the rich even richer are reserved for those who understand the game. It is technically illegal to offer speculative deals to someone who is considered not sophisticated, but of course, it happens. The more sophisticated I get, the more opportunities come my way. Another case for developing your financial intelligence over a lifetime is simply that more opportunities are presented to you. And the greater your financial intelligence, the easier it is to tell whether a deal is good. It's your intelligence that can spot a bad deal or make a bad deal good. The more I learn, and there is a lot to learn, the more money I make simply because I gain experience and wisdom as the years go on. I have friends who are playing it safe, working hard at their profession and failing to gain financial wisdom, which does take time to develop. My overall philosophy is to plant seeds inside my asset column. That is my formula. I start small and plant seeds. Some grow, some don't. Inside our real estate corporation, we have property worth several $1 million. It is our own right, or real estate investment trust. The point I'm making is that most of those millions started out as little $5,000 to $10,000 investments. All of those down payments were fortunate to catch a fast-rising market and increase tax-free. We traded in and out several times over a number of years. We also own a stock portfolio, surrounded by a corporation that Kim and I call our personal mutual fund. We have friends who deal specifically with investors like us who have extra money each month to invest. We buy high-risk, speculative private companies that are just about to go public on a stock exchange in the United States or Canada. An example of how fast gains can be made are 100,000 shares purchased for 25 cents each before the company goes public. 6 months later, the company is listed, and the 100,000 shares now are worth $2 each. If the company is well managed, the price keeps going up, and the stock may go to $20 or more per share. There are years when our $25,000 has gone to $1 million in less than a year. It is not gambling if you know what you're doing. It is gambling if you're just throwing money into a deal and praying. The idea in anything is to use your technical knowledge, wisdom, and love of the game to cut the odds down, to lower the risk. Of course, there is always risk. It is financial intelligence that improves the odds. Thus, what is risky for one person is less risky to someone else. That is the primary reason I constantly encourage people to invest more in their financial education than in stocks, real estate, or other markets. The smarter you are, the better chance you have of beating the odds. The stock plays I personally invested in were extremely high risk for most people and absolutely not recommended. I have been playing that game since 1979 and have paid more than my share in dues. But if you will review why investments such as these are high risk for most people, you may be able to set your life up differently, so that the ability to take $25,000 and turn it into $1 million in a year is low risk for you. As stated earlier, nothing I have written is a recommendation. It is only used as an example of what is simple and possible. What I do is small potatoes in the grand scheme of things. Yet, for the average individual, a passive income of more than $100,000 a year is nice and not hard to achieve. Depending on the market and how smart you are, it could be done in 5 to 10 years. If you keep your living expenses modest, $100,000 coming in as additional income is pleasant, regardless of whether you work. You can work if you like, or take time off if you choose, and use the government tax system in your favor rather than against you. My personal basis is real estate. I love real estate because it's stable and slow-moving. I keep the base solid. The cash flow is fairly steady and, if properly managed, has a good chance of increasing in value. The beauty of a solid base of real estate is that it allows me to take greater risks, as I do with speculative stocks. If I make great profits in the stock market, I pay my capital gains tax on the gain and then reinvest what's left in real estate, again further securing my asset foundation. A last word on real estate. I have traveled all over the world and taught investing. In every city, I hear people say you cannot buy real estate cheap. That is not my experience. Even in New York or Tokyo, or just on the outskirts of the city, prime bargains are overlooked by most people. In Singapore, with their high real estate prices, there are still bargains to be found within a short driving distance. So whenever I hear someone say, "You can't do that here," pointing at me, I remind them that maybe the real statement is, "I don't know how to do that here. Yet." Great opportunities are not seen with your eyes. They are seen with your mind. Most people never get wealthy simply because they are not trained financially to recognize opportunities right in front of them. I am often asked, "How do I start?" In the final chapter of this audiobook, I offer 10 steps that I followed on the road to my financial freedom. But always remember to have fun. When you learn the rules and the vocabulary of investing and begin to build your asset column, I think you'll find that it's as fun a game as you've ever played. Sometimes you win, and sometimes you learn. But have fun. Most people never win because they're more afraid of losing. That is why I found school so silly. In school, we learn that mistakes are bad, and we are punished for making them. Yet if you look at the way humans are designed to learn, we learn by making mistakes. We learn to walk by falling down. If we never fell down, we would never walk. The same is true for learning to ride a bike. I still have scars on my knees, but today I can ride a bike without thinking. The same is true for getting rich. Unfortunately, the main reason most people are not rich is because they are terrified of losing. Winners are not afraid of losing, but losers are. Failure is part of the process of success. People who avoid failure also avoid success. I look at money much like my game of tennis. I play hard, make mistakes, correct, make more mistakes, correct, and I get better. If I lose the game, I reach across the net, shake my opponent's hand, smile, and say, "See you next Saturday." There are two kinds of investors. One, the first and most common type is a person who buys a packaged investment. They call a retail outlet, such as a real estate company, a stockbroker, or a financial planner, and they buy something. It could be a mutual fund, a right, a stock, or bond. It is a clean and simple way of investing. An analogy would be a shopper who goes to a computer store and buys a computer right off the shelf. 2. The second type is an investor who creates investments. This investor usually assembles a deal in the same way a person who buys components builds a computer. I do not know the first thing about putting components of a computer together, but I do know how to put pieces of opportunities together, or know people who know how. It is this second type of investor who is the more professional investor. Sometimes it may take years for all the pieces to come together. And sometimes they never do. It is this second type of investor that my rich dad encouraged me to be. It is important to learn how to put the pieces together, because that is where the huge wins reside, and sometimes some huge losses if the tide goes against you. If you want to be the second type of investor, you need to develop 3 main skills. These skills are in addition to those required to become financially intelligent. 1. Find an opportunity that everyone else missed. You see with your mind what others miss with their eyes. For example, a friend bought this run-down old house. It was spooky to look at. Everyone wondered why he bought it. What he saw that we did not was that the house came with 4 extra empty lots. He discovered that after going to the title company. After buying the house, he tore the house down and sold the 5 lots to a builder for 3 times what he paid for the entire package. He made $75,000 for 2 months of work. It's not a lot of money, but it sure beats minimum wage, and it's not technically difficult. 2. Raise money. The average person only goes to the bank. This second type of investor needs to know how to raise capital, and there are many ways that don't require a bank. To get started, I learned how to buy houses without a bank. It was the learned skill of raising money more than the houses themselves that was priceless. All too often, I hear people say, "The bank won't lend me money," or "I don't have the money to buy it." If you want to be a Type 2 investor, you need to learn how to do that which stops most people. In other words, a majority of people let their lack of money stop them from making a deal. If you can avoid that obstacle, you will be millions ahead of those who don't learn those skills. There have been many times I have bought a house, a stock, or an apartment building without a penny in the bank. I once bought an apartment house for $1.2 million. I did what is called tying it up with a written contract between seller and buyer. I then raised the $100,000 deposit, which bought me 90 days to raise the rest of the money. Why did I do it? Simply because I knew it was worth $2 million. I never raised the money. Instead, the person who put up the $100,000 gave me $50,000 for finding the deal, took over my position, and I walked away. Total working time? 3 days. Again, it's what you know more than what you buy. Investing is not buying. It's more a case of knowing. 3. Organize smart people. Intelligent people are those who work with or hire a person who is more intelligent than they are. When you need advice, make sure you choose your advisor wisely. There is a lot to learn, but the rewards can be astronomical. If you do not want to learn those skills, then being a Type 1 investor is highly recommended. It is what you know that is your greatest wealth. It is what you do not know that is your greatest risk. There is always risk, so learn to manage risk instead of avoiding it. Chapter 6. Lesson 6. Work to learn, don't work for money. Job security meant everything to my educated dad. Learning meant everything to my rich dad. A few years ago, I granted an interview with a newspaper in Singapore. The young female reporter was on time, and the interview got underway immediately. We sat in the lobby of a luxurious hotel, sipping coffee and discussing the purpose of my visit to Singapore. I was to share the platform with Zig Ziglar. He was speaking on motivation, and I was speaking on the secrets of the rich. Someday, I would like to be a best-selling author like you, she said. I had seen some of the articles she had written for the paper, and I was impressed. She had a tough, clear style of writing. Her articles held a reader's interest. You have a great style, I said in reply. What holds you back from achieving your dream? My work does not seem to go anywhere, she said quietly. Everyone says that my novels are excellent, but nothing happens. So I keep my job with the paper. At least it pays the bills. Do you have any suggestions? Yes, I do, I said brightly. A friend of mine here in Singapore runs a school that trains people to sell. He runs sales training courses for many of the top corporations here in Singapore, and I think attending one of his courses would greatly enhance your career. She stiffened. Are you saying I should go to school to learn to sell? I nodded. You aren't serious, are you? Again, I nodded. What is wrong with that? I was now backpedaling. She was offended by something, and now I was wishing I had not said anything. In my attempt to be helpful, I found myself defending my suggestion. I have a master's degree in English literature. Why would I go to school to learn to be a salesperson? I am a professional. I went to school to be trained in a profession so I would not have to be a salesperson. I hate salespeople. All they want is money. So tell me why I should study sales. She was packing her briefcase. The interview was over. On the coffee table sat a copy of an earlier best-selling book I wrote. I picked it up as well as the notes she had jotted down on her legal pad. Do you see this? I said, pointing to her notes. She looked down at her notes. What? She said, confused. Again, I pointed deliberately to her notes. On her pad she had written, Robert Kiyosaki, best-selling author. It says best-selling author, not best writing author, I said quietly. Her eyes widened. I am a terrible writer, I said. You are a great writer. I went to sales school. You have a master's degree. Put them together, and you get a best-selling author and a best writing author. Anger flared from her eyes. I'll never stoop so low as to learn how to sell. People like you have no business writing. I'm a professionally trained writer, and you are a salesman. It is not fair, she fumed. She put the rest of her notes away and hurried out through the large glass doors into the humid Singapore morning. At least she gave me a fair and favorable write-up the next morning. The world is filled with smart, talented, educated, and gifted people. We meet them every day. They are all around us. A few days ago, my car was not running well. I pulled into a garage, and the young mechanic had it fixed in just a few minutes. He knew what was wrong by simply listening to the engine. I was amazed. I am constantly shocked at how little talented people earn. I have met brilliant, highly educated people who earn less than $20,000 a year. A business consultant who specializes in the medical trade was telling me how many doctors, dentists, and chiropractors struggle financially. All this time, I thought that when they graduated, the dollars would pour in. It was this business consultant who gave me the phrase, "They are one skill away from great wealth." What this phrase means is that most people need only to learn and master one more skill, and their income would jump exponentially. I have mentioned before that financial intelligence is a synergy of accounting, investing, marketing, and law. Combine those four technical skills, and making money with money is easier than most people would believe. When it comes to money, the only skill most people know is to work hard. The classic example of a synergy of skills was that young writer for the newspaper. If she diligently learned the skills of sales and marketing, her income would jump dramatically. If I were her, I would take some courses in advertising copywriting as well as sales. Then, instead of working at the newspaper, I would seek a job at an advertising agency. Even if it were a cut in pay, she would learn how to communicate in shortcuts that are used in successful advertising. She also would spend time learning public relations, an important skill. She would learn how to get millions in free publicity. Then, at night and on weekends, she could be writing her great novel. When it was finished, she would be better able to sell her book. Then, in a short while, she could be a best-selling author. When I came out with my first book, If You Want to Be Rich and Happy, Don't Go to School, a publisher suggested I change the title to The Economics of Education. I told the publisher that, with a title like that, I would sell 2 books, one to my family and one to my best friend. The problem is that they would expect it for free. The obnoxious title, If You Want to Be Rich and Happy, Don't Go to School, was chosen because we knew it would get tons of publicity. I am pro-education and believe in education reform. If I were not pro-education, why would I continue to press for changing our antiquated educational system? So I chose a title that would get me on more TV and radio shows simply because I was willing to be controversial. Many people thought I was a fruitcake, but the book sold and sold. When I graduated from the U.S. Merchant Marine Academy in 1969, my educated dad was happy. Standard Oil of California had hired me for its oil tanker fleet as a third mate. The pay was low compared with my classmates, but it was okay for a first real job after college. My starting pay was about $42,000 a year, including overtime, and I only had to work for 7 months. I had 5 months of vacation. If I had wanted to, I could have taken the run to Vietnam with a subsidiary shipping company and easily doubled my pay instead of taking 5 months of vacation. I had a great career ahead of me, yet I resigned after 6 months with the company and joined the Marine Corps to learn how to fly. My educated dad was devastated. Rich Dad congratulated me. In school and in the workplace, the popular opinion is the idea of specialization. That is, in order to make more money or get promoted, you need to specialize. That is why medical doctors immediately begin to seek a specialty such as orthopedics or pediatrics. The same is true for accountants, architects, lawyers, pilots, and others. My educated dad believed in the same dogma. That is why he was thrilled when he eventually achieved his doctorate. He often admitted that schools reward people who study more and more about less and less. Rich Dad encouraged me to do exactly the opposite. You want to know a little about a lot, was his suggestion. That is why for years I worked in different areas of his companies. For a while, I worked in his accounting department. Although I would probably never have been an accountant, he wanted me to learn via osmosis. Rich Dad knew I would pick up jargon and a sense of what is important and what is not. I also worked as a busboy and construction worker as well as in sales, reservations, and marketing. He was grooming Mike and me. That is why he insisted we sit in on the meetings with his bankers, lawyers, accountants, and brokers. He wanted us to know a little about every aspect of his empire. When I quit my high-paying job with Standard Oil, my educated dad had a heart-to-heart talk with me. He was bewildered. He could not understand my decision to resign from a career that offered high pay, great benefits, lots of time off, and opportunity for promotion. When he asked me one evening, "Why did you quit?" I could not explain it to him, though I tried hard to. My logic did not fit his logic. The big problem was that my logic was my rich dad's logic. Job security meant everything to my educated dad. Learning meant everything to my rich dad. Educated dad thought I went to school